Hi there, accountants. I hope all is well, and I pray that as you viewing this video, that you're in the best of health and spirit. This video will cover Chapter 12, Corporations, Organization, Stock, Transactions, and Dividends from Financial and Managerial Accounting, 16th edition. By the end of this chapter, you should be able to describe the nature of the corporate form of organizations, describe and illustrate the characteristics of stock, classes of stock, and the journal entries required when stock is being issued. We'll describe and illustrate the accounting for cash dividends versus stock dividends. We'll describe the effect of stock splits on stockholders' equity. We'll describe and illustrate the accounting for treasury stock transactions. We will describe and illustrate the reporting of stockholders' equity as it's reported on the balance sheet. And lastly, we'll describe and illustrate the use of earnings per share to evaluate the profitability of a company. So we start off with learning objective 1, which is the nature of a corporation. So generally, most large businesses are organized as corporations. So if we think about Google, if we think about Apple, if we think about Amazon, these very large corporations are organized as a C corporation. So you'll see there is what's called an S corporation. There are some nuances. There's a variety of business structures, and the different business structures, they have different rules as it relates to accounting, and they have different pros and cons as it relates to taxation. But for the most part, this chapter, we are focusing on C corporations. So most large businesses, as mentioned, are organized as corporations, and as a result, corporations generate more than 90% of the total business dollars in the United States. In contrast, most small businesses, they're organized as a proprietorship. So that's basically one individual. If they wake up one morning and say, hey, I want to start a business, there's nothing formal that needs to be done. They just start their business. One individual. So that's what's called a sole proprietorship. Then we have what's called a partnership. This is where there's 2 or more individuals that come together to start a business. And similar to a sole proprietor, they can just wake up one morning and decide to operate the business. There's nothing formal that needs to be filed with the state. The biggest disadvantage with a sole proprietorship and a partnership is, God forbid, the business is sued. They treat the owners, the partners, as an extension of the business. So if the business has no income, then they can come after the owners, the partners. They can come after them for the liability. Versus limited liability companies, these are similar to a sole proprietorship and similar to a partnership, but the key thing is that there is limited liability, so they're not necessarily going to come after the owners. So when anyone is deciding that they want to start a business, this is something that they need to consider, because obviously the structure of the business has pros and cons, and these are things to consider. So some characteristics of a corporation is a legal entity. It's distinct, and it's separate from the individuals who create it. So as a legal entity, a corporation can acquire, can own, and can dispose of property in its own name, and it can also incur liabilities and enter into contracts. So let's say I start corporation ABC. If I need to purchase a building, I can purchase it in the name of corporation ABC. I don't need to purchase it in my personal name. So corporations, separate, distinct entity. And most importantly, corporations, they can sell shares of ownership, and this is referred to as stock. We'll learn about what's called common stock, and then we'll also learn about preferred stock. So this characteristics of a corporation, it gives a corporation the ability to raise a large amount of capital, because they can sell stock not just to individuals, but they can also sell stocks to other businesses. Stockholders or shareholders, this represents who owns the corporation. So different terminology basically means the same thing. If we're dealing with a sole proprietorship, we'll call the owner an owner. If we're dealing with a partnership, we'll call the owners partners. If we're dealing with a LLC, limited liability company, we will call the owners members. If we're dealing with an S corporation or a C corporation, we call the owners shareholders or stockholders. The same exact thing, right? It means the same thing. It represents those who own the company. The only difference is that based on the structure of the business, you call it something different. Same concept nonetheless. So as the stockholders and shareholders, they can buy and they can sell the stock without affecting the corporation's operations or continued existence. Corporations whose stocks are traded on public markets, we call these public corporations. And corporations whose shares are not traded publicly, usually they're owned by a small group of investors, and this is what we would call a non-public or private corporation. The stockholders of a corporation, again, as mentioned, they have a limited liability. So in the event that my corporation is sued, ABC Corporation, they can't come after me personally. So what that simply means is that creditors, they cannot go beyond the assets of the corporation to satisfy their claims. So if I've invested, let's say, $1,000 into corporation ABC, that's the most that I'm going to lose, nothing more than that. So the financial loss that a stockholder may suffer, it's limited to the amount that they've invested into the business. So as a separate entity, corporation, as we know, it's going to be, subjected to taxes. So there's certain characteristics of a corporation, things that we need to keep in mind. So the stockholders, they control the corporation, but they need to do what's called elect a board of directors. So the board, they'll meet periodically, they'll establish the corporate policies, so the rules that essentially, govern how the corporation is going to be run. And then they select what's called a chief executive officer and other officers that are responsible for managing the day-to-day, and then they have employees. So because it's a distinct and separate entity, the rules govern that certain things need to be put in place to ensure that corporation ABC is not just operating with the intent to just evade liability. So to make sure that everyone's best interest is at heart, especially because people are investing their hard-earned dollars, right? So especially when they are public corporations, they are, under more scrutiny, and there are certain rules that are put in place by the SEC and all of these different organizations to ensure that corporations are doing what needs to be done, because again, people are investing their hard-earned money. With Exhibit 2, this is just some pros and cons. As we know, in everything in life, you have pros and you have cons. So with a corporation, some advantages and disadvantages. An advantage is that it's a separate legal existence. Again, simply stated, the corporation exists separately from the owners. Next, we have continuous life. A corporation, it can keep going, right? So even in the event if the shareholders, the original shareholders died, it doesn't mean that the corporation ceases versus a sole proprietorship. I'm the only one that runs the organization. Once I die, then the corporation stops pretty much. So with a corporation, there's continuous life. Corporations, as we mentioned, they can raise a large amount of capital, and the corporate form is suited for raising large amount of funds, again, because they can issue stocks, not just to individuals, but to other businesses as well. Ownership rights are easily transferable. So a corporation, they sell shares of ownership called stock, and you can just decide to just, sell the stock whenever you want. If you use, they have platforms like Robinhood. They have, if you have a brokerage company like through TD Bank or National Financial Services and things of that nature, you don't necessarily need to keep on to the stock. It's easy to just transfer the rights. Limited liability, this is one of the biggest benefits. A corporation creditors, again, they cannot go beyond the assets of the corporation to satisfy their claims. So the liability is limited to however much the stockholder or shareholder originally invested into the corporation. Some disadvantages: the owner is separate from management. So again, stockholders, they control management, but not directly. It's indirectly through a board of directors, and the board of directors, obviously, they need to be independent. So the board of directors, they should represent the shareholders' interests. However, the board is often more closely tied to management than it is to shareholders. So as a result, management and board of directors, sometimes they don't always do what's in the best interest of stockholders. There have been so many cases of, fraud, financial misconduct that has taken place because, unfortunately, the board of directors, they care more about what management want, not necessarily what is best for the stockholders. Another really big disadvantage of a C corporation is that there's a double taxation of dividends. So a corporation is a tax-paying entity, much like individuals. So the challenge is, when a corporation, they has their net income, let's say they have net income of $10,000, with the Tax Cuts and Jobs Act, they just pay a flat 21% tax on that $10,000 of net income. And now, as a shareholder, when distributions are issued in the form of a dividend, when the individual files their personal tax return, they also need to report the dividend as income, and Uncle Sam gets a piece of the pie. So that's one of the biggest challenges with a C corporation. So this is something important for a smaller corporation to keep in mind, because hey, it ultimately all depends on the situation. Maybe this will work out best, maybe it's not. So with a sole proprietorship, whatever income, net income you have, it's all going to be subjected to one level of taxation at the individual level. But with a C corporation, however, it's taxed at the business level, and it's also taxed to the individual because it is treated as dividend. So something very important to keep in mind. Next, you have regulatory costs. The corporations, they must satisfy many requirements, such as those required by the Sarbanes-Oxley Act. So again, as mentioned, there's a lot of financial misconduct that took place, and there needed to be greater oversight with companies like Enron, right? There were people that literally, they lost their life savings because they invested into this corporation, but their accounting records were incorrect. Well, let's just call it what it was. It was basically fraud, right? And this is not not something that never happens. It happens. So with all reality, there is a greater level of scrutiny for C corporations because they are, taking money from investors who are individuals just like myself and yourself, as well as other businesses, and they want to make sure that they have the shareholders' best interest at heart. So next, as it relates to forming a corporation, again, it's not just like a sole proprietorship or a partnership. You can't just wake up one morning and say, hey, I am running a corporation. There are things that need to be filed with the state. So there's a formal process that needs to be done. The first step in forming a corporation is to file what's called an application of incorporation with the state. State incorporation laws differ, so it really all depends. A lot of times you'll hear that some individuals, they will choose to register in a state that has more favorable laws. So here we see more than half of the largest companies, they are incorporated in Delaware, even though their headquarters is somewhere else. After the application of incorporation has been approved, from there, the state is going to grant a charter or articles of incorporation. So here's the key thing. It says once it has been approved. So it does not necessarily mean that as soon as you file this application of incorporation with the state that you can function and operate as a C corporation. It doesn't work that way. So that's something very important to keep in mind. But again, once it has been approved, then that charter or articles of incorporation will have been granted. And the articles of incorporation, that is what formally creates the corporation. The corporate management and board of directors, then they would prepare a set of bylaws. So the bylaws, this represents rules and procedures for conducting the affairs of the corporation. So this governs, hey, if, they want to purchase a new building or something like that, how many people need to sign off before the building is purchased or something like that. So again, the bylaws are the rules and the procedures in order to conduct the affairs of the corporation. So these are just some examples of the corporations and their state of incorporation. So here we have Alphabet Inc., Google. They are headquartered in Mountain View, California, but they are incorporated in Delaware. Apple's also in California, Cupertino, but they are incorporated in Delaware. So again, these really large corporations, Delaware for the most part, is one of the states that has the most favorable tax laws as it relates to C corporations. So the place where the business runs its operations does not necessarily mean that is where the state, the corporation rather, needs to incorporate. So forming a corporation, obviously, there's going to be some money involved. So costs may be incurred in organizing an organization. This could include legal fees, taxes, the state incorporation fees. And again, depending on the state, that will determine how much it costs to submit that application, licensing fees, and promotional costs. Such costs are debited to an expense account entitled organizational expenses. And here we have this example, a corporation's organizing costs of $8,500 on January 5th are recorded as follows. So we see January 5th, they incurred organizational expenses of $8,500. We debit that account because we know anytime we want to show an increase to our expense account, we must debit it. And we credit cash. Why? Because we know anytime we want to decrease an asset account, in this case, cash, we paid cash, which means there's a decrease. We credit that asset account, which in this case is cash. So we debit organizational expenses and credit cash. So as it relates to a C corporation, there's two main sources of stockholders' equity. The first is paid-in capital or contributed capital. This basically represents the amount that the owners invest into the corporation. And then we have what's called retained earnings. So the main source of paid-in capital is from issuing stock. So the number of shares that a corporation is authorized to issue, it's stated in this charter. The term issued, this basically refers to the shares that have been issued to the stockholders. And a corporation, maybe they'll decide for whatever reason, they'll reacquire some of the stock that is issued. That we'll learn later in the chapter. That is called treasury stock, stocks that the corporation purchases back. And the stock that's remaining in the hand of the stockholders is called outstanding stock. So corporations, sometimes they'll issue stock certificates to stockholders to document their ownership. And this would be printed on a stock certificate. It would have the name of the company, the name of the stockholder, as well as the number of shares that are owned. So here with this exhibit 4, it basically just, helps to provide a depiction of the relationship between authorized shares, as we see here, issued shares, and outstanding stock. So upon request, again, sometimes the corporations, they can issue these things, and then we'll learn about what's called par value. So the stock certificate, it can indicate a dollar amount assigned to each share of the stock, and this is referred to as par value. So stock, it doesn't necessarily have to be issued with par, and if it, doesn't have, then it's called no par stock. So in some states, board of directors of a corporation, they are required to assign a stated value to no par stock. So again, really all depends on which state the corporation is incorporated in. And in order to protect creditors, some states, they require corporations to maintain a minimum amount of paid-in capital because, again, some people that are really smart, what they will do is, hey, let's form this C corporation. We have no liability, and they will engage in, high risk activities because in their mind it's like, hey, if what they say, the fan hits the ceiling or the ceiling hits the fan or whatever it is, then all they're going to lose is what they invested. So some states, they require no. To protect those that invested into this corporation, they need to maintain a minimum amount of paid-in capital. And I will assume that if they do not keep that, minimum balance, there's going to be some penalty. Maybe they lose their C corporation status, right? So same thing, if you think about it in your everyday life, certain bank accounts, if you don't keep a certain minimum amount in your bank account, what do? They charge you a fee, right? So the same thing applies. This minimum amount is called legal capital, and it usually includes the par or the stated value of the shares that have been issued. The major rights that accompany ownership of a share of stock, they're as follows. So they have the right to vote in matters concerning the corporation. They have the right to share in the distributions of earnings, and they have the right to share in assets upon liquidation. And these stock rights, they normally vary with the class of stock. So we'll learn that there's not just one class of stock, there's more than one. So the two primary classes of paid-in capital are what's called common stock, and then we have what's called preferred stock. So when only one class of stock is issued, it's called common stock. So each share of common stock has equal rights. A corporation, they can also issue one or more classes of stock with various preference rights, such as a preference to dividends. So in such case, a stock like that is called a preferred stock. So obviously, with common stockholders and preferred stockholders, there are some nuances relating to the rights that they have. So the dividend rights of preferred stock are stated either as $1 per share or as a percent of par. So here we see preferred shares, $4 stock, $50 par, or preferred 8% stock, $50 par. So again, stated either as dollars per share or a percent of par. So the dividend preference as follows, preferred means that they are preferred. They receive preference to dividend distributions. Common shareholders, they're the common folk. They come after and they get what's left over, if anything, pretty much. So this is just a depiction of how it goes. Preferred shareholders come first. They are preferred. And the common folk, they just common. They get what's left over, if anything. So here we're going to discuss some of the types of stock. So the payment of dividends is authorized by the corporation's board of directors. So there's certain steps that essentially are going to take place before dividends are even distributed. So the payment of dividends, first things first, it needs to be authorized by the corporation's board of directors. And whenever it is authorized, the directors are set to have declared a dividend. So they are declaring, hey, you know what? We are going to pay our shareholders a dividend, right? So they're basically making the commitment to do such. And then we have what's called cumulative preferred stock. So with cumulative preferred stock, this is where the preferred shareholders, they have a right to receive regular dividends that were not declared or paid in prior years. Non-cumulative, on the other hand, doesn't have this right. So for those of you that, want to invest in stocks in a company, this is something to consider. Don't want to be a preferred shareholder whereby, I am guaranteed to receive dividends. And if I am a preferred shareholder, is it cumulative preferred stock or is it non-cumulative? So quick example, let's say, in year one, we were supposed to get $5,000 in dividends, but there was no money. If it's non-cumulative, okay, you pretty much just have to suck it up. You didn't get the $5,000 versus if it's cumulative in year one, they owe you $5,000. And in year two, when they issue, let's just say 5,000 again, what's going to happen is in year two, they're going to pay you $10,000 in dividends, 5,000 from year one and another 5,000 from year two, versus if it's non-cumulative, year one, you basically lost out on that 5,000 in dividends and they're only going to give you 5,000. So very, very important to note the difference, especially if you want to invest in the stocks of a corporation and be a preferred shareholder. So anytime there's cumulative preferred stock dividends that have not been paid in prior years, these are considered to be in arrears. So it's due, it's owed to the preferred shareholders. And any preferred dividends that are in arrears, they must be paid before any common stock dividends are paid. So again, from the perspective of an investor, you want to, think, hey, do I want to be a common shareholder or preferred, right? Because hey, here it says the preferred shareholders, they're going to be paid first before common stock dividends. So in the event that, dividends are in arrears, and let's say the company isn't performing as well as it would like to, as a common shareholder, you might get no dividends at all. So this is something very, very important to keep in mind. So here it states, assume that a corporation has issued the following preferred and common stock. There's 1,400 shares of cumulative preferred $4 stock, $50 par. And it says 4,000 shares of common stock, $15 par. The corporation was organized on January 1st to 20 year one, and they paid no dividends in 20 year one and 20 year two. In 20 year three, the corporation paid $22,000 in dividends. So here's the key thing to keep in mind. It says cumulative preferred stock. So if it was non-cumulative, unfortunately, they would lose out in year one and lose out in year two. However, here we see, because it's cumulative, we need to take care of our preferred shareholders for year one and year two. So in 20 year three, the corporation paid $22,000 in dividends. $12,000 is going to be paid to the preferred shareholders. And again, the common shareholders, they basically get what's left over. And before we look at the next slide to determine how we came up with the amounts 12,000 and 10,000, another key thing to keep in mind with the difference between preferred shareholders and common shareholders is, in addition to dividend preference, preferred stockholders, in the event that, let's say, the company goes out of business and it needs to liquidate, liquidation basically means how fast we can turn things into cash. So maybe the corporation needs to start selling some of its equipment, selling some of its real estate. Once they do that and they liquidate it, they turn the assets into cash. Preferred dividend shareholders, or preferred shareholders rather, they have the preference to the liquidation. Common shareholders, they're common folk, they might get nothing. So here we see total dividends paid. Again, in 20 year 3, they paid 22,000. And how did we determine? So if we look here, it says 1,000 shares of cumulative preferred stock, $4 per share, right? $4 stock. So with that being said, there's 1,000 shares, and for each share, they are guaranteed to receive $4 per share in dividends. So for 20 year 1, the dividends in arrear is 1,000 shares multiplied by 4. So we owe them $4,000 for year 1. And in 20 year 2, same thing, 1,000 shares for $4 per share. We owe them 4,000 for year 2. And then in 20 year 3, same thing. So here we see the corporation distributed 22,000, but we need to take care of our preferred shareholders, not just for year 3, but also for years 1 and 2. So after we take care of the preferred shareholders for years 1, 2, and 3, there's only $10,000 left over. That's what goes to the common folk, all right? So again, very important to keep this in mind, not just for purposes of going through this chapter, but from a perspective of someone who potentially wants to invest in a corporation. So here we see issuing stock. So when stocks are being issued, is very important, obviously, to account for each class of stock that's issued to investors in a corporation. So with that being said, there's a separate account used for recording the amount of each class of stock issued to investors. Assume that a corporation is authorized to issue 10,000 shares of $100 par preferred stock and 100,000 shares of $20 par common stock. The corporation issued 5,000 shares of preferred stock and 50,000 shares of common stock at par for cash. So in such case, the journal entry would be as follows. So it lets us know that we issued 5,000 shares of preferred stock, and each stock is worth $100 par. So 5,000 multiplied by $100 gives us 500,000. And then it lets us know that we issued 50,000 shares of common stock. So 50,000 shares multiplied by $20 par common stock, that gives us a total of 1 million. So 500,000 for the preferred stock, 1 million for the common stock. In total, the corporation raised $1.5 million. So stock is often issued by a corporation at a price other than its par. And the price at which stock is sold, it depends on a variety of factors. This includes the financial condition, the earnings record, and dividend record of the corporation, the investor's expectations of the corporation's potential earning power, general business and economic conditions, as well as expectations. So in the event that the stock is sold for a price that is more than its par, then the stock was sold at a premium. If the stock is sold for a price less than its par, then the stock was sold at a discount. So this is fairly similar to when we are dealing with bonds, right? When bonds are sold for less than the face value, it is sold at a discount. And when bonds are sold for more than the face value, it's sold at a premium. So similar concept. Large public corporations, normally they'll use a financial institution such as a bank in order to keep track of the stockholders. And in such cases, the financial institution is referred to as a transfer agent or a registrar. So premium on a stock, again, this is where more is paid, in comparison to the par value. So when stock is issued at a premium, cash is going to be debited. Why? Because cash is coming into the business. It's an increase to an asset, so we debit it. And then common stock or preferred stock is going to be credited for the par amount, and the excess, the extra of how much was paid, it is going to be credited to the paid in capital in excess of par account. So here we have this example. It says, assume that Cadwell Company or Caldwell Company issues 2,000 shares of $50 par preferred stock for cash at $55. So it's worth $50 per share, and they give us an extra $5 per share. So the journal entry would be as follows. 2,000 shares multiplied by $50 per share. We received cash of $110,000. However, what is the value of our preferred stock? 2,000 shares, and the value per share is $50. So therefore, we credit the preferred stock for the value, And then the difference between the two, we see that they gave us $5 extra. So $5 multiplied by 2,000, the paid in capital in excess of par preferred stock, we record the premium at $10,000. Whenever the stock is issued in exchange for assets other than cash, maybe they give land or buildings or equipment, the assets acquired are recorded at their fair market value. And let's say in the event that the fair market value, it can't be determined. We don't really know what it is. In such case, the fair market value of the stock that was issued is going to be used. So here we have this example and it says, assume a corporation acquired land with a fair market value that can't be determined. And in exchange, the corporation issued 10,000 shares of its $10 par common stock. And if the stock, if it currently has a fair market value, a market price of $12 per share, then the transaction is going to be recorded as follows. Again, because we don't know what the value of the land is, we basically take the fair market value of the stock. So 10,000 shares multiplied by the market price of the share, which is 12. So the land is recorded at 120,000. The common stock, much like the preferred stock, it's always going to be recorded based on its par. So in this case, 10,000 shares, and each share is worth $10. We credit common stock for 100,000, and from there, we credit the paid in capital in excess of par. The shares are worth $10 and we are recording it at $12. So $2 in premium in excess multiplied by the number of shares. That is how we get the credit to paid in capital for $20,000. Sometimes there's no par, right? So this is something to keep in mind. So in most states, no par preferred and common stock can be issued. And whenever no par stock is issued, cash is going to be debited, common stock is going to be credited for the proceeds. And whenever no par stock is issued over time, just keep in mind the entry is going to be the same even if the issuing price varies. So here we have this example. It says, assume January 9th, a corporation issues 10,000 shares of no par common stock at $40 a share. On June 27th, the corporation issues an additional 1,000 shares at 36. These are the journal entries. So again, this is no par stock. We didn't really assign a value to the stock. So in such case, we debit cash for how much money we receive and we credit the value of the common stock for, how much we sold it for pretty much. So in such case, 10,000 shares of no par common stock, 10,000 by 40. We debit cash, credit common stock. And on June 27th, it's similar. In this case, we issued 1,000 shares at 36. Same journal entry. The only thing that changes is the amount. And again, in some states, no par stock, it may be assigned what's called a stated value. And the stated value, it's recorded similar to a par value. And in such case, any excess of the proceeds that's over the stated value is going to be credited to paid in capital in excess of stated value. So again, if there's no par, then however much you sold it for, that's what you are going to credit the common or preferred stock for. But if it is assigned a stated value, it's treated similar to par value, and any excess is going to be credited to a paid in capital in excess. But as we see here, it says in excess of stated value. And if we go up to the previous problem, we see paid in capital in excess of par. Similar thing, the only thing is that one has a par, this one doesn't have par, but it has a stated value. So it says, assume that in a preceding example, the no par common stock was assigned a stated value of $25. So in such case, cash is $400,000 because again, we issued, as it lets us know here, 10,000 shares at $40 and 1,000 shares at 36. And now before, there was no par value at all. But in this case, the facts change a little bit because there was a stated value of 25. So in such case, 10,000 shares multiplied by the $25 per share. And next, on June 27th, it's the 1,000 shares multiplied by the $25. So we see that the facts change a bit because of the stated value. So once you understand how to record the journal entries for par value stock, it's similar to no par value stock that has an assigned stated value. So now we move on to accounting for dividends. So we just looked at recording the journal entries for the issuance of stock. Now we're actually going to account for dividends. So whenever a board of director declares a cash dividend, this is basically the corporation authorizing the distribution of cash to the stockholders, right? Because if you think about it, if you are investing in a corporation or you're starting your own company, let's not even think about it on, a corporate level. Anybody who starts a business, why do they start it? They want to make money off of it, right? They want that if I invest $1,000, I want to flip this $1,000 into 10,000, 15,000, right? So if you are investing money into a corporation, you want to make something off of it. You want to return on your investment. So that is what a dividend represents. So whenever a board of director declares a stock dividend, it authorizes distribution of the stock. So we see that there's different types of dividends. We have cash dividends and we have stock dividends, and sometimes there's also what's called property dividends. So in both cases, declaring a dividend, it ultimately reduces the retained earnings of the corporation because distributions are made out of the retained earnings. So a cash distribution of earnings by a corporation to its shareholders, obviously, it's a cash distribution, it's a cash dividend. So although dividends, as mentioned, they can be paid in other assets, cash dividends are generally the most common. Like I'm invested in a few stocks. I'm not as well versed in investing as I would like to be, but I trust I'll get there. But for the most part, I have like a few little stocks in Robinhood. And sometimes, I'll get an update like, hey, this corporation gave you 14 cents in dividends. Imagine if I invested more, it could be 1,400. It could be 14,000, right? It could be $14. But again, it all depends on your ownership. That ultimately determines how much your cash dividend is going to be. And I'm a common shareholder. So what does that mean? The preferred shareholders receive preference. And as a common folk, I just get what's left over, right? So although dividends, again, they could be paid in other assets, cash dividends are the most common. There are three conditions for cash dividends as follows. There needs to be sufficient retained earnings, because if you think about it, let's make it practical. If you have a business and the business isn't making money, how are you going to take money out of the business? It's just not going to work. You need to make sure that there's sufficient enough cash, again, because what good would it be if you have this corporation and there's only $5,000 in the bank to keep operations going, and as the owner you take all $5,000? There needs to be sufficient cash to keep the operations going. And lastly, there's going to be a formal action by the board of directors. They are going to make the decision. They are going to authorize issuing the dividends. So again, there needs to be a large enough balance in the retained earnings in order to declare a cash dividend. And even if there are sufficient retained earnings in cash, a corporation's board of directors, keep in mind, they are not required to pay dividends. So something very important to keep in mind. So special or extra dividends may also be paid when a corporation experiences higher than normal profits. So let's say the corporation is having a really, really great year. They can decide, hey, you know what? We are so grateful to our shareholders, our stockholders. They invested money in this corporation, and without their investments, we wouldn't be able to function. Let's share some of the love. So there's three dates included in a dividend announcement as follows. The date of declaration. This is the date that the board of directors, they formally authorize the payment of the dividend. So again, this is where they are holding themselves accountable. They are, recorded on the books that there is an obligation that we are going to pay dividends to our shareholders. Next, we have what's called the date of record. And this is the date that the corporation uses to determine which stockholders are going to receive the dividend. So based on the date of declaration, there's going to be a cutoff point. So let's say we decided that as of May 1st, we are going to, pay dividends to our shareholders. Somebody that came and invested in a corporation on May 15th, they're probably not going to get a dividend, right? They were not a part of the corporation as of the date of declaration. So that would be like, a small example of how they determine who gets the dividend and who doesn't. And then lastly, we have the date of payment, right? The date that the stockholders, the shareholders are looking forward to when they get the cash dividend. So here it states, assume that on October 1st, Haber Corporation declares the following cash dividends with a date of record on November 10th and a date of payment on December 2nd. So here we see we have preferred stock shareholders. We have $100 par and there's 5,000 shares outstanding. And our preferred shareholders are going to get $2.50 per share. And we have common stock, $10 par, and there's 100,000 shares outstanding. And the dividends per share for our common stockholders is 30 cents per share. So we, do the math. 5,000 shares by 250 gives us $12,500, and 100,000 shares of common stock by $10 par. Total dividends is 30,000, so for a total of 42,500. So again, this is the date of declaration. They debit cash dividends and credit cash dividends payable. Why are we crediting dividends payable? Now they have a liability. The organization, the corporation, has an obligation to pay the dividends to the shareholders. So that's the declaration date. On the date of record, there's no formal journal entry, right? This is just a date that merely determines which stockholders are going to receive the dividends. There's nothing that needs to be reported in the books. December 2nd, when we actually make the payment, the journal entry is going to be as follows. We debit the cash dividends payable. Why? Because we know liabilities are increased with a credit, as we see in this example. And then when we decrease the liability, we debit it, as we see in this example. So this is where we are officially taking care of our liability, our obligation to pay our shareholders. And we credit cash. Why? Because it says we paid. We know anytime we see the word paid, we paid cash. And then at the end of the accounting period, the balance in cash dividends is going to be transferred to retained earnings as a part of the closing process. So again, cash dividends are generally the most common, but sometimes they'll issue stock. So a stock dividend is a distribution of shares of stock to stockholders. Stock dividends, they're normally declared only on common stock and issued to common stockholders. A stock dividend affects only stockholders' equity, and specifically, the amount of the stock dividend is transferred from retained earnings to paid in capital. And the amount that's transferred is normally equivalent to the fair market value, aka the market price of the shares that were issued in the stock dividend. So here we have this example. It says, assume that the stockholders' equity accounts of Hendricks Corporation as of December 15th are as follows. We have common stock, $20 par. There's 2 million shares that have been issued. So the total value is 40 million. And then we have paid in capital in excess of par common stock for 9 million. And our retained earnings value is $26,600,000. So now it states on December 15th, Hendricks declares that they are going to declare a stock dividend of 5% or 100,000 shares. So 2 million multiplied by 5%, that is how we determine the 100,000 shares. And these shares are going to be issued on January 10th to stockholders of record as of December 31st. And here it states that the market price of the stock on December 15th, which was the date of declaration, it was $31 per share. So therefore, our journal entry would be as follows. Again, they declared a stock dividend of 5%. So we have 2 million shares in total. We multiply it by the 5%. So therefore, we're going to give out 100,000 shares. And as of the date of declaration, it was worth $31 per share. So we debit stock dividends of 3,100,000. We credit the stock dividends distributable. And then from there, we credit the paid in excess of par. So wait, how do we determine this 2 million? If we scroll back up, we see that each share is worth $20 and we are promising to issue stock dividends of 100,000 shares. So 100,000 multiplied by 20 is how we calculated this 2 million. So therefore, we see that there was a paid in capital in excess of par. The difference between the market price and the par value of the common stock. And at the end of the period, stock dividends distributable and paid in capital in excess of par, they're going to be reported in the paid in capital section of the balance sheet. And on January 10th, the stock dividend is going to be distributed to the stockholders by issuing 100 10,000 shares of common stock. And the journal entry we see as follows. We debit stock dividends distributable and we credit common stock. One key thing to keep in mind, a stock dividend, it doesn't change assets, it doesn't change liabilities, and it doesn't change total stockholders' equity of a corporation. Likewise, a stock dividend, it doesn't change an individual stockholders' proportionate interest, their equity in the corporation. So it states, assume a stockholder owns 1,000 of a corporation's 10,000 shares outstanding. So in the event that the corporation declares a 6% stock dividend, the stockholders' proportionate interest is not going to change. So how do we know? All right. So before the stock dividend, the total shares that the corporation had issued rather is 10,000, and the number of shares owned by the shareholder is 1,000. So 1,000, which represents their specific percentage or their specific amount of ownership of the shares, divided by the total shares, they own 10%. Now, let's say after the stock dividend, they decided to declare a 6% stock dividend. 10,000 plus the 10,000 multiplied by 6 gives us 10,600. And then now the number of shares owned for the shareholder increased from 1,000 to 1,060. So therefore, the number of shares owned divided by the total shares owned, the percentage of interest, the equity remains the same. So next we have what's called stock splits. So kind of similar. So as we're looking with a stock split, it's a process by which the corporation reduces the par or the stated value of its common stock and issues a proportionate number of additional shares. So a stock split, this applies to all common shares, including the unissued as well as the issued shares. One of the major objectives of the stock split is to reduce the market price per share of the stock. Here we have this example of saying, assume that Rojic Corporation has 10,000 shares of $1 par common stock outstanding with a current market price of $150 per share. Now, the board of directors, they come together and they decide, hey, we are going to declare a stock split. And what it states is that each common shareholder, they're going to receive 5 shares for every 1 share that they have. So this is called a 5-for-1 stock split. So as a result, 50,000 shares, 10,000 shares multiplied by 5 are going to be outstanding. So what this simply does is that the par value of each share is going to be reduced to $20. Originally, it was $100, but because we had a stock split, for every 1 share, you're going to get 5 shares. Now, the mark or the par value of each stock is going to be reduced. The par value of the common stock outstanding is 1 million, both before and after the stock split. So again, the only thing that changes in this situation is that there's just more shares, right? But the proportionate value is still the same. So before the split, there were 10,000 shares, and the par value of the shares were $100 for a total of 1 million. And now after the split, for every 1 share, they get 5 shares. So there's 50,000 worth of shares, but again, the total value is the same. So the par value of the share decreased to $20. So each Rojic Corporation shareholder, again, they still own the same total par amount. They just have an increased number of shares. So here, this exhibit, it basically shows a depiction again. So before the stock split, you have 4 shares at $100 per share. And then after the 5-for-1 stock, instead of having 4 shares, you now have 20 shares. And each share, instead of being worth $100, is now worth $20. So as we look at Exhibit 8, this is basically just, giving us a depiction of dividends and stock splits. So stock splits, one thing to keep in mind is that they do not require a journal entry. The reason being because only the par or the stated value and number of shares outstanding have changed, but the details of the stock splits, they'll be disclosed in the notes to financial statements, right? Because again, at least, those that potentially want to invest in a corporation or, using the financial statements for whatever reason, they want to have some insight into the stock split. But again, no journal entry is required. Dividends and stock splits, they affect stockholders' equity differently. However, as we see here, common stock, once there's a stock dividend, it increases whenever they have been distributed. Stock dividend is distributable. When we have a stock dividend, it increases when declared and decreases when distributed. Paid in capital is increased when stock dividends have been declared, and the retained earnings in both situations, whether it's a cash dividend or a stock dividend, it decreases the amount of retained earnings. Next, we have what's called treasury stock. So without treasury stock, this is when a corporation, again, they issue shares and then the corporation reacquires it. They buy it back pretty much. So a corporation, they can reacquire, they can repurchase its own stock for a variety of reasons. Sometimes they want to provide shares for resale to employees. Maybe they want to reissue the shares as bonuses to employees. And sometimes they do it to help support the market price of the stock. So the cost method is normally used for recording the purchase and resale of treasury stock. And using the cost method, treasury stock is going to be debited for the cost, which is the purchase price of the stock. And any difference between the cost and the sell it price is going to be debited or credited to paid in capital from sale of treasury stock. So we have this example. It states, assume a corporation has the following paid in capital on January 1st. Common stock, $25 par, and there's 20,000 shares authorized and issued. And then we have excess of issue price over par for a total of $650,000. So the corporation entered into the following treasury stock transactions. February 13th, they purchased 1,000 shares of its common stock at $45. April 29th, they sold $600 or 600 shares rather of the treasury stock for 60. So again, we purchased it at 45 and then we sold it for 60. And then on October 4th, we sold the remaining 400 for 40. So we purchased it for 45, but we sold it for 40. So we have an example of a gain, and then we have an example of a loss. So no dividends, cash or stock, are paid on the shares of treasury stock. So this is very important to keep in mind. No dividends paid to treasury stock. To do so obviously would result in the corporation earning dividend revenue from itself. So treasury stock, there's no dividends. So in such case, February 13th, what we would do, debit treasury stock, and we would credit cash because we paid $45 for 1,000 shares. And then now on April 29th, we sold 600 of the 1,000 shares for $60. So we had a gain of $15. How do we know? We purchased it at 45, we sold it at 60. So 60 multiplied by 600, we received cash of 36,000. But again, the 600 shares were purchased at 45. So 600 by 45 is 27,000. And the difference between the 45 and the 60, that amount is credited to paid in capital from the sale of treasury stock. And then lastly, on October 4th, this is where we sold it for less than we purchased it. So the remaining 400 shares were sold at $40. But again, we paid $45 for it. So with that being said, we debit cash for the amount received, $40 multiplied by 400, 16,000. The treasury stock, the value is the $45 times 400 shares, and the difference represents the paid in capital from sale of treasury stock. So I know I used the verbiage gain or loss, but as it relates to treasury stock, we don't credit gain on sale of treasury stock. Instead, we use the paid in capital from sale of treasury stock to record either the gain or the loss. So this brings us to learning objective 6, reporting stockholders' equity. So as with other section of the balance sheet, there's some alternative terms and formats that may be used in reporting the stockholders' equity. So whenever there's changes in retained earnings and paid in capital, they may be reported in separate statements, or sometimes it's disclosed in notes to the financial statements. So there's two methods for reporting stockholders' equity. So method 1, this is where each class of stock is going to be reported, and it's followed by its related paid in capital accounts. And then retained earnings is going to be reported and followed by a deduction for treasury stock. Method 2, this is where the stock accounts are going to be reported. followed by the paid in capital reported as a single line item, additional paid in capital, and then retained earnings is going to be reported, followed by a deduction for treasury stock. So here we have a depiction of the two methods. So with Exhibit 10, this first one, again, each class of stock reported, followed by the related paid in capital as we see. So here we start off each class of stock. We have preferred, we have common stock, and then we have the paid in capital. And then we see that treasury stock is a reduction. So this is a depiction of method 1. And then in method 2, this is where the stock accounts are reported. So we have preferred stock, we have common stock, because again, here we see it's broken out. Preferred stock, and then the essence, or the excess rather, of paid in capital, common stock, and the excess of paid in capital. But here, it's all coming together. So we have preferred stock, then common stock. Then we have additional paid in capital, one line item. And then from there, we have our retained earnings and a deduction to treasury stock. So both methods obviously just yield the same thing. But as we can see with method 1, it is more detailed versus method 2. So whenever there's retained earnings, there's changes in retained earnings, it could be reported using one of the following. Maybe there's a separate return earnings statement. Sometimes we have combined income and retained earnings statement, or we have what's called the statement of stockholders' equity. So whenever there's a separate retained earnings statement being prepared, the beginning balance of retained earnings is also going to be reported. So we have the beginning balance of retained earnings. We show any increases, decreases, which ultimately leads to us determining our ending balance of retained earnings. So changes in retained earnings, they can also be reported in a combination with the income statement. So here we have this example here. This is Telex Incorporated. We have our retained earnings statement. We start off with the beginning balance. Our net income increases our retained earnings, and then the dividends that we've paid out, it decreases our retained earnings. And then once we net the increase of net income and the decrease of dividends paid, we have a total change in retained earnings. And once we factor in the increase and decreases, that leads us to our ending retained earnings balance. So there are some restrictions as it relates to retained earnings. So the use of retained earnings for payment of dividends, it can be restricted by actions of the corporation's board of directors. So sometimes with these restrictions, it's called appropriations. So with that being said, the restrictions on retained earnings are classified as legal. So again, this is where the state, they require a restriction of retained earnings. They require a minimum amount to be set. We have what's called contractual. So this is where a corporation, they can enter into contracts that require restrictions of retained earnings. And then we have what's called discretionary. So this is where a corporation's board of directors, they may restrict retained earnings voluntarily. Maybe they know that within 5 years they want to expand. Maybe they want to expand into international markets. So they're like, hey, you know what? Instead of paying dividends now, let's hold off, because our shareholders, they would get a greater return as we plan to invest in these international markets, or, maybe create new products, new services, whatever it is. They are retaining the earnings with the anticipation of essentially making more money. So restrictions of retained earnings, one key thing is they need to, it doesn't say maybe, it says must be. So restriction of retained earnings must be disclosed in the financial statements. So next we move on to prior period adjustments. Again, sometimes there's errors. We're dealing with numbers, there's a likelihood. Sometimes it could be a computer error. Sometimes it can be a human error. So an error may arise from mathematical mistake or a mistake from applying accounting principles. So sometimes these errors are not discovered within the same period they occur. So in such cases, the effect of the error shouldn't affect the current period's net income. So in the event that there was an error that wasn't discovered until the books, until after the books were closed. So instead, the correction of error is called a prior period adjustment. And when they make the adjustment, because the revenue and expense accounts have already been closed, we account for it by making an adjustment to the beginning balance of retained earnings. Because as we know, our balance sheet accounts are our permanent accounts, and our revenue and expense, as well as our dividend accounts, are temporary accounts. So next we have our statement of stockholders' equity. So whenever a corporation has changes in stock and paid in capital accounts as well as retained earnings, we have what's called a statement of stockholders' equity. So this is similar to what we saw with the retained earnings, right? We essentially start off with the beginning balance. We have some increases, we have some decreases, and then from there we get to our ending balance. So with the statement of stockholders' equity, it's prepared in a columnar format where each column is a major stockholders' equity classification. So here we have preferred stock, we have common stock, we have additional paid in capital, retained earnings, and treasury stock. And so again, each of these are broken out based on the major stockholders' equity classifications. So reporting stockholders' equity for Alphabet. So this is just an example. So we have Alphabet Incorporated reports stockholders' equity on its balance sheet. It also includes a statement of stockholders' equity in its financial statements. And here it shows the stockholders' equity section of Alphabet's balance sheet as of December 31st. So here we see it's broken out. We have class A, B, C common stock. We report our additional paid in capital. We have accumulated other comprehensive loss, retained earnings. And from there, we see our total stockholders' equity. And here we see this asterisk, and it lets us know other comprehensive income or loss is discussed more fully in Appendix B. So there's notes in the financial statements. Here we see the statement of stockholders' equity for Alphabet. So as we mentioned, it's in a columnar format. We have common stock and additional paid in capital. We have accumulated other comprehensive loss, and then we have retained earnings. And then as we see this asterisk again, there are notes disclosed in the financial statements to give individuals more of an understanding, like what is other? Like imagine if you are an investor and you are going to be invested in a corporation, you're going to be looking at this like, what does other mean? Other can mean anything. So that's why it is required to be disclosed in the financial statements. And this brings us to the last objective, analysis for decision making, right? So net income is often used by investors and creditors in order to evaluate a company's profitability. So as an investor, I need to decide, hey, do I want to invest in, ABC Corporation, or do I want to invest in XYZ Corporation? So investors use the financial statements for decision making. So one ratio used for analyzing profitability is the earnings per share of common stock outstanding during a period. And sometimes this ratio is referred to as EPS, earnings per share, or sometimes called basic earnings per share. Corporations whose stocks traded in a public market, they must, it doesn't say might, must report earnings per common share on their income statement. So earnings per share is computed as follows. It's the net income of the corporation minus the preferred dividends, because remember, the preferred shareholders, they receive preference to dividends, but the common folk, we want to figure out, how much, if anything, are we going to get in dividends? So therefore, net income minus preferred dividends divided by the average number of common shares outstanding. So how do we get the average? It's the beginning number of common shares outstanding at the beginning of the year plus the ending amount of common shares outstanding divided by 2. That is how we get the average amount. So here we have the following data in millions, except the per share amounts were taken from the recent financial statements of Facebook. So here we see the net income in the recent year. It was $18,485. And the average number of common shares outstanding was 2,854 shares. So simple math, right? Again, the net income divided by the average number of shares in the recent year, the earnings per share is $6.48. Versus in the prior year, where the net income was 22,111 and the average shares outstanding was 2,890. So now in the current year, it's $7.65. So this is something to keep in mind, right? We see that there was a decrease. In the prior year, it was $7.65, and now it's $6.48. What's the reason for this, right? So if you look a little further into it, a decrease in earnings per share is considered obviously an unfavorable change. So it could be due to a number of reasons. Maybe there's some litigation with Facebook. Maybe there's a new social media platform that came out that is taking precedence over Facebook. So there could be a number of reasons, but obviously as it decreases, that is considered unfavorable. So here we have exhibit 13, and with this exhibit, it basically just depicts the effect of stockholders' equity transactions on earnings per share. So if we issue common stock, right, what happens? It increases our earnings per share, or it increases the number of common stock outstanding, but it decreases our earnings per share of common stock. What about if we have a stock dividend or we have a stock split? Obviously, this increases the number of common shares we have, and it ultimately decreases our earnings per share. So the reason why this exhibit is so important is because from management's perspective, board of directors, they're looking at it like, hey, if we decide to, issue these dividends, it's going to have a decrease on our earnings per share, which is reported on the financial statements. So once, board of directors, they're making these decisions to issue dividends, to purchase treasury stock, to issue new shares of stock, they factor in and they look at it from a holistic perspective. What is the impact that it will have on the number of common stock outstanding? And what is the impact that it is going to have on our earnings per share? All right, so this brings us to the end of chapter 12, corporations, organizations, stock transactions, and dividends. So now that this lesson has ended, you should have learned how to describe the nature of a corporate form of organization. As we know, you can't just wake up one morning and start a corporation. You need to file the formal documentation with the state, and once it is approved, then you can operate as a C corporation. We describe and illustrate the characteristics of stock, classes of stock, and the journal entries for issuing stock. As we know, we have common stockholders and we have preferred stockholders. We described and illustrated the accounting for cash dividends and stock dividends. We described the effect of stock splits on stockholders' equity. Again, the shareholders' proportionate interest doesn't change. It's just that now they own more shares. We described and illustrated the accounting for treasury stock transactions. This is where the corporation buys back their stock. We described and illustrated the reporting of stockholders' equity as it relates to the balance sheet as well as the notes to disclosure that are required. And then lastly, we described and illustrating the use of earnings per share in evaluating a company's profitability. So again, this brings us to the end of chapter 12, corporations, organization, stock transactions, and dividends.